Welcome all. Ira Epstein, and here we are. And we're with our financial market wrap up, and this is for Wednesday, the 13th of July 2022, and the time 6:24 p.m. Central Time. So, we had today the inflation reading, and on the inflation reading, the way you have to look at it is way bigger than anybody guessed. I saw no one with a 9.1% headline number. So what it does is it gives the Fed the ammunition to go for, guess what, 100 basis point increase. Why not? You got a strong job market. You have inflation that, according to the numbers that they're looking at, still strong as a bee. Why can't the market accelerate things? You don't have to go as long. So with that, what's been taking place is now you're getting traders saying, if the Fed does that, the market won't need to go as far on the 10-year and the 30-year bonds with hikes, and that is why they've been stalling against the 2-year. Now you'll get corrections back and forth. You got jobs data coming out in the morning, so you want to pay attention to that. The other thing that traders are trying to figure out, stupidly, is to pick a top in the dollar index. Why? Everything for the dollar is still strong. Yes, at some point it'll let go, but the slow stochastics will do its job and show that to us. In the metals, I looked at the rally today as a gift, going, hey, why would you be buying the metals? The dollar's so strong, you're slowing things down, you got a jobs report tomorrow that could add more fuel to the fire. The other argument, you still get people talking that you're going to see crude at $140 to $150 a barrel. I question if you got, now the Bank of Canada went 100 points today. You just had New Zealand raise their interest rates. It's bank after bank. They're all on the same parade to slow down demand. If you're going to slow down demand, and if there's no supply shock, even with the low numbers that we're getting in crude of 1 million barrels a day not meeting the OPEC plus quota, why does it have to advance from here nearly 50%? I'm not understanding the argument. I'd understand the argument if you're telling me the economies are going to be strong and needing it. I don't understand that argument. So I'm trying to understand in my own mind, what am I missing, because I just don't buy into what the crowd is saying. Keep your eye on the grains. We're at the point in grains where they have fallen so much that they're very susceptible now to the bounce off weather conditions. Now the bad news is for the wheat market that they're working hard for countries, including supposedly the U.S., to find a way to get corridors to ship out Ukrainian grain. Well, more supply is only going to be more bearish. You're already at $8.10. You're not at $12 anymore. So yeah, that is not inflationary, right? So I'm having trouble understanding a couple of things. The inflation that we have has to be the inflation the Fed is fighting from rents, which won't change overnight. It has to be employment, wages. That I can see. You can change that fairly fast, but not people you just hired. You're not going to call them into a corporate meeting and say, hey, guess what, everybody? I got to cut your salaries 10%. You know that isn't going to happen with the market. And if you're looking at some of the numbers like came out today, the online help wanted index, it's stronger. I mean, there's still the demand for it. This all makes sense then for the Fed to go to the 100 basis points. You got a strong labor market, a slowing economy, but not one falling off a cliff. Go for it. Get ahead of the inflation number. When we take a look at the S&P 500 index, let's look at what we've got. For the week, you're still down 3%. You had a bounce, you're giving it up, but we're only midweek. Tomorrow's Thursday. Let's see what the employment number looks like. But there's nothing bullish on this chart at this point in time. And you can see you're still leaking away. But remember what I've recently told you. You seem to be caught between here, the high right through here in the market of 42.05 to this break low right down into here of 36.39, and you're just going sideways here all of a sudden. In terms of a trend, you don't have one on the swing line. The brown line is a swing line. If you took my charting course, you'd understand how it's plotted. You could do it. If you use our charting software, it plots it for you if you select the indicator. If you take the course, I explain it in such a way you can write your formula for other charting services. Should work out pretty well. But what you have is the trend up until and unless the market takes out 37.43.75, at which point you'd still then not be trending. You'd have a higher high and a lower low. Number two, the market is under the 18-day average of closes. That is bearish. When it's over it, the bias is up. So I have been telling you that I don't think the pros should be buying at 38.24. They got a huge risk in the market. You got a risk to this low right here, 37.43. I don't see professional traders wanting to risk 100 points. The other thing I'm beginning to get bothered by in all the stock indices is they're developing one of these sideways Bollinger patterns. And from those, big trends do develop. Now that is the good thing. What is the trend going to be? Long term, I say it's down. I don't see that this is how this market finishes off this sell-off. I think you're going to have more weakness. I look at slow stochastics and I have momentum down there. Not oversold, but getting it at any reading under 30 would be oversold. In other words, plain English, I don't see anything to do. When I step to the NASDAQ, it is the identical pattern. I see myself with the trade caught between this upper Bollinger Band right here. The lower one, if you can get back to it over here, it did hit it in these zones, as you can see. Momentum down, bias down, but the swing line up. When we come over to the Dow, it's caught in the Bollinger Band the same way. I think you can clearly see what I'm saying. The 18-day average, you're in sideways markets all of a sudden. Same in the Russell. Recognize it. Sideways markets are son of a gun markets. They're day trading vehicles, not position vehicles. In the VIX cash, where are we failing on the rallies? I feel like I'm taking you back to charting 101. First challenge, after you give up the 100-day average and get under it, you come up, you got resistance there in the 18-day. Now the last rally high in the market was 27.92, and that was made on July 5th. 29.82. Today you got to 29.06. That's not taking it out. So the pros are still in the bear camp here, but it didn't fall very far and you weren't able to keep the stock market up. That's the divergence between them. Normally the VIX down means the stock market is up. In the 30-year bond, my arguments are that this thing's going to be a son of a gun to get through these moving averages way up here. The market is going to be looking and saying, especially if the Fed goes 100 basis points, they're slowing the economy down so much and determined to keep it going that you don't have to take the back end to those crazy numbers. That's not going to slow the economy down. It's the front end. I've given you the whole dissertation right there. Same in the 10-year note. None of these are in bear trends. They're in uptrends temporarily. They do revert down if you take out the lows of yesterday in this market. And if I come back, not quite there in the bond. You'd have to take out this low. But when you and I come over and we, look at the dollar index, while people are trying to pick a top, why? This is that classic. You've got the Gorilla Glue trade on. You know it. Most people don't. You have the embedded reading with it. Lose the embedded reading with a move under 79 on a close. I'm no longer bearish. No longer bullish. Don't do that. And I say the pros are buying this break, looking for it back to the Bollinger Band until that eventuality takes place. Now our Prime Day sale ends tonight, that's Chicago time at midnight. Our computers are set, they will turn it off, and you won't be able to get 50% off on any of my research. Introductory prices included. So normally, for example, we're $7.95 to try 30 days of my morning subscriber video. It's half of that. You would give up if you do that and don't buy the 1 year, getting the year off for half. So normally it's $156. Be what, $83. So you have to make some decisions. Same thing goes for my morning spider by itself, the combo of the two, or my full research. And this is for new and returning members. So to find out more, go to our website, but you can take your cursor, move it all the way to the top here, and you will see an icon appear. Click it and sign up. You have until midnight and then it's not coming back. I'm Ira Epstein. Thanks for listening. Have a great day.